Greetings. Hope you're all well. Good news for our friends and colleagues and service providers in Victoria, specifically in Melbourne, that it looks like their cases are now under control and they're soon going to be coming out of lockdown somewhere within the next 3 weeks, or certainly an easing of restrictions there. I know that they're going to be very happy and relieved about that. Of course, there's some serious economic downside to all of that. And I thought that perhaps I'd speak about that for just a few minutes in today's video communication. What really got me thinking about this is that a couple of days ago in Business Insider, there was an article from StockSpot, which is one of the government advisors into super funds, saying that super fund returns for the last year averaged somewhere between 9% per annum and minus 2% per annum. This obviously got me thinking, because clearly one of the target markets for our Zagga loan investments are self-managed super funds. The other thing that adds to this is that in the last few days, there's been a lot of speculation in the press about the property market and what's going to happen, more particularly because our Treasurer, Josh Frydenberg, has made an announcement urging the banks to rethink their lending policies and is going to be passing legislation which in effect is going to reverse some of the restrictions that have been placed on the banks in giving loans, to make it easier for them to give loans and to put the onus for responsible lending back onto the borrower, i.e. in the form of responsible borrowing as opposed to responsible lending. Against that, there's still a number of players who are speaking about a crash in the property market, reductions of more than 20% in property prices and things like that. And all of that really suggests that perhaps we should spend a few minutes talking about how we at Zagga see this going forward. Now, at this point in time, I really need to emphasize that what I'm about to tell you is not in the form of any advice whatsoever. I'm not giving you financial advice. I'm not telling you what to do. I'm simply sharing some of the opinions that we hold over here. And those opinions really are ours. They're informed by what we read and what we know. But please, I'm not asking you to rely on them in any way. Simply hear them. Feel free to agree or disagree with them. But be sure that you make your own investigations. And when you do take out a loan, you do so for reasons that are germane and pertinent to you, and that you've done all the proper investigation to go behind it. So moving then just on to the first point, which is the superannuation point and the returns on super. There's no doubt that in Australia, certainly yields are at an all-time low. We know that the Reserve Bank of Australia have said that if they need to reduce the interbank rate to below 25 basis points, they'll do that, although right now they're trying to hold that there. But the impact of that is that for most deposit products, returns are under 1% per annum or just over 1% per annum. In fact, I saw an advert in the paper the other day for a money market product offering people a whopping return of 2.35% per annum. I mean, where have the days gone of substantially higher returns? So if you are managing your super fund, you've got a number of difficulties. Number one, if you're in the market, you've got the volatility that goes with the market. You've got sequencing risk, which means that's the risk of actually getting your money out for the right value on the day that you want it out. And we all know that in markets, it's very hard to pick the timing. Yields, as we know, are exceptionally low. Markets are volatile, and alternative asset classes traditionally hold more risk. But from where we sit, we really do believe that the kind of alternate asset class that we offer, which is a loan product underpinned by a first registered mortgage over a property which has been independently valued, and where you can get access to the underlying mortgage, yes, while risky, is certainly risk of an eminently manageable kind. And there's no doubt that if you have been an investor in Zagga since we started just over 3 years ago, you would have actually have enjoyed a return in real terms of well over 9%, and on an internal rate of return basis of over 11%. Compare that with some of the self-managed super funds, which are returning minus 2%, or if you've just held your money in cash in the bank, where right now you're getting under 1%, bearing in mind, of course, that rates have come down by more than 1% in the last year. And if you're only in equities, then you would have had the ups and downs of the equities market recently. You may have gotten out on time. You may not have gotten out on time. You may not have gotten out at all. And you will have all of the issues, because we all know that with an equity, you haven't made the profit until you've sold it. So if you are managing your super, there are a few things you need to think about. Number one, what is your investment strategy? What do you want to achieve? We believe that an alternate asset class such as ours fits within any well-constructed portfolio. It's not there instead of any other asset classes. It is there to basically prop up the middle, somewhere between your super conservative, very low returns and your super aggressive, very high returns. There is that middle ground where you get a transparent, almost bankable, certainly certain and assured return, which you're going to know you're going to get on the day when we say you're going to get it. Obviously, you need to think about what returns do you want. We're in a reducing market. Returns are not what they used to be. But my view is if you're getting from us 7% or thereabouts against a money market rate of well below 1%, well, you're doing significantly better than the market. Super funds are traditionally subject to fees, especially where they're investing in other kinds of investment funds. You need to be sure that the returns you're being quoted are after fees, not before fees. You need to understand what your fees are going to be. And in our case, of course, as an investor, the return we quote you is your net return. There are no fees involved. That's the amount that you get. I already spoke about sequencing risk, but if you're in the market or any other product, you need to make sure you can get out in time. And on the day you get out, you're actually going to get the money. With one of the Zagga loans, you know that, you know what the term is, you know what you're going to get when that term comes out. It may be 1 or 2 days late just because of the vagaries of how property works in Australia, but by and large, you're going to get your money. And we've done that now almost 100 times across 100 loans for many, many, many dozens of investors for well over $400 million in total investment. So we're confident about that. And at the end of the day, as we all know, you've got to diversify. You cannot have all of your eggs in one basket. And as I said earlier, not suggesting that you should have all of your money in a Zagga loan, but you should certainly be thinking about having some of your money in the Zagga loan. Let me leave it at that. Obviously, as always, if you have any questions or if you'd like to know any further information, feel free to contact us, info@zagga.com.au or alan@zagga.com.au. We'll only be too happy to take your questions. Until the next time, take care, be safe, stay well, and looking forward to seeing you soon.